All right, welcome back to another episode of Evaluating Mortgage-Backed Securities. What happened last week and why? So we start off on Monday, and this is the area that we're talking about, these 5 candles here, and you can see what a week. We actually had some massive recovery in the rates, which is great. Remember, there's an inverse relationship. As mortgage-backed securities get stronger, mortgage interest rates go down. So big movement. Let's talk about why. Make sure you listen to the whole thing because there's a lot of really important data that's going on that's going to indicate kind of where we could be headed. All right, let's start off with this Monday. This was really an indecisive range. Not a lot of news coming out. There was a big question about the Bank of Japan. What are they going to be doing? There's a lot of word about Japan. They're actually accelerating their debt, and the yuan is actually taking a nosedive. So it's something that could potentially impact the world. So what this does is it basically puts everybody kind of in a holding pattern. What's going to happen? But there's also some analysis based off of what is happening with the Fed math. So if you look at the past 7 months of rent and owner's equivalent rent, which makes up 43% of the core index, the inflation core index that the Fed is using to gauge whether or not their interest rate implementation is actually having impact on the economy. Well, if that's 43%, that's totaling somewhere between 5.8 and 5.9% over that 7-month period. So if you applied like weighing of that, those two categories are adding roughly 2.5% of the inflation that we're seeing. And what that means is that if the Fed wanted to get to the 2% core inflation, the rest of the measurement, the rest of the components would have to average negative 0.5%. That'd be very hard to do unless they actually break the economy, right? So it puts them in a tough spot. So that being the case, and if you actually analyze that, it kind of leads to the idea, well, things are working and we may not get to that arbitrary 2%, but the economy is slowing down. So the very next day, which was Halloween, we walk into that and we're looking at housing prices. So housing prices are still continuing to increase. The Case-Shiller Home Price Index is basically saying that it's going to go up somewhere around 6%, home appreciation around 6% this year. And the FHFA House Price Index is talking about something very similar. Now, home prices rose about 9% in the first half of 2022, fell about 3% in the second half, and they're going to complete the year somewhere around 6% appreciation. So we're on pace for 6 to 8% based on the pace through August. So the pace may slow down, but this is still very, very strong housing appreciation. Even in some of the markets that people were saying were down, they're recovering. So this is super important to know that the housing market is still strong, even though interest rates are high. Now we walk into this monster right here. This is massive because we had, as you can see throughout here, we're in a tight trading range, and then we get into, this 76.4% Fibonacci that also goes into this moving average, and we just bust through it. So what happened? Well, there's a lot of things going on there between the JOLTS report, which shows job openings that are increasing for the first time, and the lawsuit that's out there, as well as manufacturing data. Now, ISM manufacturing data came in at 46.7, which is lower than the 49 in the previous report. So basically, employment has dropped 46.8, and prices were at 45. So all of this is a contraction. So what's happening is we're actually starting to see cracks in the economy, and it's starting to go down. And I had a sneaky suspicion that people kind of knew what the Fed was going to be talking about the next day, and they hit it early so that they could take some profits here. So this was massive, a massive movement, a very good day for us, and I'm very happy to see finally a candle going in our direction. When we walk into Thursday, this is where the Fed is speaking, and really he came up with some dovish talk. Okay, so we're in here and you see it doesn't have the same impact because I think people had already kind of known what was going to happen. And we're also looking at the 61.8% Fibonacci. So it was going to get stuck around here. And the question is if it could close above it. And if it does, that's massive. On a technical standpoint, just from my experience, anytime that you break up here and you hold up between this, it almost always hits at 61.8. So it's almost a sure bet that rates were going to continue to get better the next day. But then you had the Fed talking, and he's actually reduced really his hawkish talk, and he's been being more dovish. So it's really looking as if they're in a wait and see holding pattern because they're looking at everything that's going on, and I think they're kind of afraid of breaking the economy. I mean, they want to be strong and they want to move it in the right direction, but they want to make sure that they don't absolutely break. They're still trying to work that mythical soft landing. We'll see if they pull it off, but it's going to be difficult. And then initial jobless claims also came in here, and it's actually for the first time we're showing that jobless claims rose. They rose about 5 grand. Still relatively low, but older reports were revised higher. So if you look at the past 7 weeks, they've risen about 167,000 in jobless claims. So that's pretty significant. Now, the other thing that you have to think about is that when we look at this Friday here, what we're looking at there is there's a big movement where, from a technical standpoint, we are busting up above the 61.8, but more importantly, we're bumping up against this moving average. So it kind of rejected it Friday, but it could have been spent as well, from the movement here. And, people jumping on going, oh, we're hoping that, rates are going to get a little bit better. We may have seen a little tightening. We may have seen the cooling off of the market. Maybe we're at the bottom and we can still finally recover. Who knows where to go from here? It can bounce up and down, but this is really a good sign. Now, if we look at average earnings that came out on Friday, so a lot of what we're seeing is if people aren't being laid off, the average hours that they're working now is down around 34 hours a week, which 40 hours a week is full time. So we're actually really dropping in the amount of hours that people have worked. And if you take a look at that, it may not sound like a whole lot, but across 168 million people who make up the labor force, that would equate to 2 million job losses, right? That's how much cutting back these hours are actually impacting. So there's a lot of data that's being processed out there. And to go along with the technicals, we're probably going to end up in some type of trading range, but we'll see what comes out next week. Next week, we've got mortgage applications, initial jobless claims, 30-year bond auction, things like that coming out. So not sure how much the market will move, but this is definitely what we have wanted to see. Now let's get you some perspective here. So this is just the last quarter. So if we look at, this is for the last year. This is where we were. We're kind of entering back to where we began in the year. And it was in this tight trading range for most of it and then began to drop. Well, boom, just like that, we got back at least up until last September. And you can see since September, over a month and a half, how quickly it dropped. So it's good to see that we have a little bit of relief. Now, there's all kinds of points of resistance here. Ceilings, each level of these here going back in history creates another level of resistance. So we've got a lot to go. Plus, these moving averages have been on this downward trend for quite a while. So if we were to actually trend this out, we're pretty close to that. So the question is, will it stay above or will it come back down again? It could go into a trading range in here. We just won't know. Let's look at the 2-year. A little difficult to see here, but you can see here's the precipitous drop. Here's the trading range. Down we went, and now we're coming back up again. We can only hope that this is the beginning of the end and perhaps interest rates will start to come back in our favor. If they do, something for everybody to keep in mind, that all those people that were waiting on the sidelines because they wanted interest to get better, well, the housing prices are still going up, right? Inventory is still low. So as these interest rates get lower and more people want to buy a house, housing prices will continue to climb. So if you want to buy a home, there's no better time to buy than right now because you're going to get a potential deal compared to what we're going to see in 2024. All right, I hope this helps. If you guys have any questions, let me know. Leave comments below. And until next time, I look forward to seeing what the market offers. Have a great day.